and welcome to Nick's Investment Lab. Today we are going to take a look at one of my concoctions. This is what I call Nick's low volatility conservative-ish portfolio. Alright, so where you see portfolio, that is going to be the low volatility conservative-ish portfolio. And where you see benchmark, that is going to be our comparable. So I'm comparing this up against a conservative balanced portfolio from a competing firm, quite a good one at that. This one is has won the Lipper Award here in Canada multiple times for best of its asset class. So I wanted to show you a comparable against a worthy adversary at the very least. Furthermore, I wanted to give a comparison for the type of product I would actually use this in place of. So what I mean by this is a conservative balanced portfolio, or even a conservative portfolio, is often good for, in some cases, retirees, also for people with a shorter time horizon, or people that aren't necessarily wanting a great degree of volatility within their investments. So what I mean by all of this is, if you are taking regular payments from something, you probably don't want to see it drop by 20% at any given moment, as number one. That's pretty scary. But number two, if you are actually taking money from it, and taking money out at the bottom actually has a greater impact than taking payments out while things are a lot better. Because if you're at $25,000 and you're taking out $500 a month, if things drop to $12,500 and you continue taking out $500 a month, you don't necessarily have that same opportunity to recover as somebody who was at $25,000, isn't withdrawing from it. Yeah, you're down at the $12,500 as previously mentioned, but you still have that opportunity for it to recover. So I guess with that being said, I think that this is a fair comparison, because once again, a low volatility portfolio is something I would want to use, and something I do use for people that don't necessarily want that same degree of risk, or that same degree of fluctuation, the same degree of volatility. With all that said, I normally like to look at asset allocation as a first starting point, and especially when I'm doing comparables. Now, what's funny about this is, so once again, the portfolio here is the low volatility one, and the benchmark being the conservative balance. So very, very different structure. The conservative balance, very high on fixed income, 62%. This one only has 3.76% fixed income. So very, very different. I think what is kind of quirky with this one is we have a very other or not classified category, as well as a very high cash position as well. So there's reasons for that, but once again, we'll get into that a little bit more as we go. So the reason I have these as comparables is because of why we would use them. So once again, here we can see performance. Here you will notice, once again, a blue bar, blue line graph with blue underneath it, as well as the red or the orange portfolio one here. So the portfolio I'm mentioning is, once again, the red or the orange line here, and the comparable being the blue one. And I think up until right here, you could argue that these funds were pretty comparable, at least in regards to performance. Now, what happened here? This, it says 10-21. That would have been, right, this line here would have been October of 2021. So beginning of 2022 is when Russia launched their war on Ukraine. We saw grain prices go up. We saw fuel prices go up. And from there, we saw inflation go up. And when inflation started to go up, the central banks started raising interest rates, and consequently, the stock market fell, and we also saw bond markets fall as well. So both of those reasons is why we saw even a great performing conservative balanced portfolio fall by, as you can see down here, 9.13%. And this is, I'll mention too, is the F series or the fee-based version. If we were talking about the transactional or more retail version, it actually would have been about 1% more to the downside, so about -10. So a bit of a moot point, but if you're comparing against your own funds, for example, that might be applicable. In any case, 2022 was really this inflection point where I really started to question the traditional way of investing. I mentioned once again, why am I worth a damn? Why listen to me at all? It's for this different way of thinking. So in 2022, I started asking wholesalers. So I have the benefit of meeting with a variety of different wholesalers or sales reps from different fund companies. Now, once again, I use the word salespeople, and a lot of people have their back up a bit, but I do believe that a lot of the ones that I have the chance to work with are pretty good at showing me the best that they have to offer. And once again, the same as I do with my clients, I have an aligned interest with my clients as these wholesalers do with me. If they show me funds that do well for my clients, I am more likely to use them. They get more sales out of me, and I continue to leverage their products. Just as if I do well for my clients and make them money, they're more likely to continue to want to utilize me and my services. So once again, everybody's interests are aligned here. So I do have a lot of trust in wholesalers, but I also do approach things with a bit of a critical eye. Anyway, all this to say, I wanted to start finding things that were lower volatility than a conservative portfolio with a higher return than a GIC. That was my whole mentality. And I started to find a variety of funds that weren't necessarily constructed the same way, as evident here, as your traditional conservative or conservative balanced portfolio, but did the job, and I will argue did the job better. So I'm unwilling, unwilling is a fair word, to divulge all of my investment holdings within this. There's 6 different ones, but 4 of them are individual funds, and 2 of them are a couple different ideas. So the 4 different investment ideas are all different low volatility strategies. So and leveraging a different variety of approaches. So as you can see here, calendar returns each year versus this conservative balanced portfolio. I'm going to say in the good years, it's outperformed, generally speaking, and 2019 is where you could argue otherwise. But anyways, 2022 though, when we saw the markets fall, this portfolio actually was continued to make money. Not as good as the other years, albeit, but it didn't fall, which is interesting considering most things that year did fall. Worst 3-month period ever, or worst decline over a 3-month period would have been from January 2020 to March of 2020 when COVID happened. Once again, relative to the market, that was not a bad drop. And the worst 1 year, or worst 12 months would have been from August 2016 to July of 2017 by 0.16%. Now, I did mention too, I have some grievances when we look 2019 and backwards, because looking at the 10-year returns on here, one of these funds came to be in 2017. Once again, the 5-year return quite good. This 2011 fund is actually the comparable that we're looking at. A couple of these go way back, so like the 2000, for example, and the 2009 we got some good history on. 2013, but anyways, one of the funds also from 2020 and another one from 2018. So I take some prior to 2018, because I don't necessarily think that prior to 2017, this portfolio only had half of its actual components. So to some people, that's a bit of a red flag, to be blunt, because a lot of investors see longevity as a good thing, right? Having a 10-year history. But I think the interesting thing here too is, and I mentioned in the video previous, that I talk about liquid alternatives, talk about short selling, talk about derivative use. There is a lot of it within this portfolio, and derivatives and options and short selling all in isolation can be very risky strategies. That's why we're leaving that to the professionals. We're leaving it to, and once again, not just one individual portfolio manager. We're leveraging a variety of different ones because I'm not willing to bet that on one person to get it right. Historically, all of them have done well here, but once again, seeing how the portfolio has done here, this is a risk-reward scatter plot. I always used to say back in the day, I guess, that anything to the above and left of the benchmark, it would be a slam dunk, meaning that that means you get a better return for less volatility. And once again, I mean, this is backwards looking, right? And I mean, hindsight is always 20/20, but mentality being that if the future was to have another market drop, which it will, you want to have a portfolio, at least in this case, that is designed to weather that storm. That is designed not to necessarily fall with the market. Not to say it won't fall at all, but not to the same degree. I liked looking at Sharpe ratios and Sortino ratios as a measure of risk-reward ratio as well, right? So, and Sharpe ratio, Sortino ratio is more so focused on growth-oriented ones, so I don't necessarily think that that's fair looking at a conservative portfolio. And once again, I didn't design this portfolio. I actually didn't point out the upside on this because I didn't want to very intentionally. Because when we look at the 5-year return, you're seeing a 14% return, which is absolutely fantastic. But I don't think that's something an investor going into this kind of a portfolio should expect. The last number of years have been pretty ridiculous, to be blunt. And I think that going into a portfolio like this, or an expectation of 7 to 8%, is probably a lot more realistic. The benchmark you see here has done 7%. I honestly think that the benchmark that we're looking at, despite the fact that it is a good portfolio that does what it does well, should expect closer to 5 to 5.5%. So once again, I do think all these numbers are a little inflated, but I do also believe that the portfolio, the concoction that I've come up with, does do the job better. And once again, does it differently, but for your average client, I think it's going to do what you want it to do. I have also said, maybe not on YouTube, but in other places, that you don't need 3,000 different underlying holdings. This has 2,600 different stocks and 689 total bonds. Do you need that for adequate diversification? No. But are you likely to lose all your money when you have it spread out between 3,000 different companies, governments, and varieties of places? Probably not. So it's sometimes a little bit of extra peace of mind. Main goal from today is I just wanted to demonstrate that this is one of the benefits of working with a financial professional. This is kind of the thought process that goes into portfolio construction. I will disclose I am licensed to provide investment advice in Canada. I do work for a CRO licensed firm. I do hold a financial planning designation, but I am not licensed as a portfolio manager. I'm working towards that, but not something that I have currently. So I do want to disclose that. I do manage investments for clients, so that is something I do. So this is within my wheelhouse, but I'm not licensed as an official portfolio manager, so I don't want to lead anybody astray there. Lastly, I like looking at portfolio upside and downside capture ratios when looking at comparables. Anytime you see 100 is kind of your baseline. So if we see 100 on the upside, that would mean that the portfolio versus the benchmark has equal upside based off the last 1 year. And if we saw 100 on the downside, that would mean equal downside. Now, anything above 100, once again on the upside, means that the portfolio that we're looking at has more upside potential based off of markets doing what they've done over, in this case, the last 1 year, 3 year, 5 year, 10 year, whatever. So you can see over the last 1 year and 5 year, the portfolio has had more upside potential than the portfolio that we're comparing against. over the 10-year, 15-year lower. Once again, I've given my reasons why I don't necessarily agree with the 10 and 15-year numbers, because this portfolio concoction really has only existed for the last 5 to 7 years, we'll say. But where it really holds its value, once again, portfolio downside. So if we saw even 80, if we saw 80, 1 year said 180, that would mean it had the same upside potential as the other comparable fund, but with only 80% of the downside. So if the portfolio had the benchmark fell by 10%, your fund theoretically would have only fallen by 8. This is saying that if the benchmark fell by 10%, your portfolio would have fallen by about 1.9. So quite significant. When we see negative, that's straight up insanity. That's meaning when the benchmark fell, you made money, which, as we saw, 2022 was true. So the main thing that I find impressive about this, and what I was striving for, was to not have that same market correlation. And that's where the derivative use, that's where all this other stuff comes in, and that's really what we're trying to get out of this. So I hope that gives you a good idea of kind of what I have to offer, at least in regards to low volatility and safer investments. I do, on the growthier side, utilize a variety of different products as well to help elevate returns. But I will admit that for even some of my more moderate growth strategies, I do utilize a lot of the same underlying holdings, and just maybe not necessarily have that be 100% of the portfolio. Maybe we do 50% of the portfolio in these safer or more low volatility kind of funds, and then we go growthier for the other 50%. So really, intention today just to show you kind of what I do. This is just a sliver of it too. I do financial planning. As I mentioned, I do have a designation for that. Is a big part of what I do as well, and that's just a lot more individualized, so a little tough to do in this sort of video format. But I hope you found this interesting. If you've made it this long, once again, props. And once again, give us a like, comment, subscribe, and once again, send any business inquiries or questions over to nicksinvestmentlab@gmail.com. Thank you so much, and have a wonderful day.